In terms of the interns exercise, if I break the low there, we're in a sell trend, because that's a failed auction, right? That's it, guys. That's the class. That's as simple as market structure can be. Now you may be saying, yeah, but what? Exactly, but what? There's obviously the Wyckoff concept of what kind of volume appeared on this phase here, and what kind of volume appeared on this phase, and what kind of volume appeared on this phase. We analyze that to give us a little bit more information that we can actually use, right? But in terms of structure, we've got to start with basic structure. Now inside basic structure, when does that structure close? When does that structure stop for the interns? Well, it stops if the price goes above that price there, doesn't it? So any other price, this is a sell zone, do you understand? So unless the price goes above that black line, would you all agree that this area here is a potential sell? Whatever happens in this area, it's a sell. Anything happens in this area, it's a sell. You understand? So we could have slightly bigger volume up candles. We could have declining volume up candles. We have a sell. It's only a sell, and it really will only ever be a sell if we're going through the interns process. Donna agrees. That's not bad out of 85. I guess I've got a lot of work to do to convince the other 84 people, Donna. I wonder if, obviously everybody thinks, no, it's a buy because I've got a bottom edge. That's the point I'm trying to avoid, right? Trying to avoid you guys buying necessarily this bottom edge. We can get to the bloody bottom edge at some stage, right? We'll get to the bottom edge if you understand Wyckoff. We'll get to the possibility of buying that pesky bottom edge. That's more to do with volume, but it's also to do with structure. The only trade we can take here is a sell based on structure. If the price rallies, what's the trade? A sell trade. Where's the sell trade? Well, it's between the top black line. It's between the top black line and possibly a lean, possibly a drop-off in volume for a squeeze, possibly a BSG squeeze at the bottom edges. It's a sell trade. If the price does this, we're still in a sell trend. The sell trend will only be broken and changed if we take out that price, which is the interns structure we've been teaching for decades. Yes? In other words, when the price goes lower, the only trade we'll be doing in here is a what? A sell. It's the only trade we'll be doing in here. So we'll be looking for a little spring trades inside this area. We'll be looking for block leans. We'll be looking for momentum reversals. We'll be looking for drop-offs in volume to then join in with a trade. BSGs, tipping points, springs. BSGs, tipping points and springs, so long until the price stays below that blue line. That's all we're looking for. When does it change? It changes when we either go above the blue line or below the red line. Why does it change if we go below the blue line? Because obviously, if it goes below the red line, because obviously I'm assuming, of course, that the price is just reversed out of there to create that red line in the first place, because when it goes back below that red line, we start again. We start again, yes. We do. Siri loves that. Okay, so we go again. Now, obviously, if it doesn't do that, and it does this, and it does this, there's a possible spring trade, there's a possible Heisman trade, there's a possible whatever trade, there's a possible tipping point trade, there's a possible BSG trade, and we're off again. When we go off again, there's the high, the price doubles back, there's the low. What's the trade? It's only a sell trade. It's only a sell trade, yes? Now, what's so difficult about this? When we go through the logic of this, we're always trading towards the weak hand buyers. Unless the buyers are strong enough to reverse the market, we're not going to be interested in buying with them. We're not fading at any stage as the price breaks lower unless we add a Wyckoff to this storyline. And if we add value to this storyline, we can't fade in any technical structure unless we add volume to the story. So inside the world of purely technicals, this is very straightforward. Would you all agree with me on that? I'm sure you would. There is nothing else you can do but agree with me on this. It's all very straightforward. Now, let's think about that for a second. Let's think about that from an oil perspective on a 5-minute chart for a second. The reason a 5-minute is because we can go down an easy time frame into a 1-minute chart to see a little bit more detail. If I decide I want to go along the lines of using oil as a structural market, where do you start the exercise from? And I don't mean to do this whole class today, guys, because obviously we did it. We did an article on it, but I want to make sure you get it. Okay, we start at a low swing, and because there's always a temptation to keep going back and back and back and back, further and further and further to find elements. Okay, but we can start with a low swing, and we can start with a high swing that's been taken out, which is here. So with the high swing getting taken out, we can now draw the bottom edge here. We can now draw a new top edge. Now, obviously, this is where subjectivity comes in. Pin rejections don't necessarily count because it's not buyers at higher prices, it's sellers. But this one did close and had 2 pins, not just one, whereas this has got 1 single pin at the top edge. So you might want to leave the line where it's at. Subjective, yep, I accept that. And obviously what happens is it doesn't make any difference because we get a close below this level, yes or no. So during this phase, the only trade, when we took out that, the only trade we could do is to be long. But the long trade happens to be anywhere from the high price to the low price. So we could be long anywhere between 111.80 and 110.40. That's a 140 tick long range, but that's the trade. That's where it is. That's what we're doing. Now, obviously, we've got a few other techniques we can do. There was obviously a very, very obvious resistance support level here. That's part of the Wyckoff initiation bar narrative that would have found as an opportunity maybe to go long into that phase there. And obviously, that takeout of the top edge was glorious and obviously a nice opportunity to make money. When the price drops back down, you're still only long, so you may well have decided to try and bid back into this. There's one of the potential fades. There was a little spring fade here, which would have been quite nice. And again, you would have been able to make some nice money. 111.40s traded a high price of 111.60s, 20 ticks. Back down to the bottom edge, the price closes below the bottom edge. What's happened? Well, what's happened, of course, now is that the narrative's changed. You're now a structural short trader, okay? And if you're a structural short trader, when does that change? Well, structural shorts change here, because obviously, as far as the intern's concerned, anything below that price is now a failed auction, yes? Anything below that price is now a failed auction. So you're not selling this trade, by the way. That's not a trade. You're never going to sell that. It's a breakout. That's a mad trade, right? So this is obviously where we start getting into some stories, because you can see that the price traded a little spring trade there, which was inside the blue area. So there was a little spring trade opportunity there. There was a little tipping point opportunity there. And there was a little BSG squeeze opportunity there. Now, they're all volume-based stories, so we'd have to look at the volume to see whether any of those trades actually made sense. But do you see where you'd have got your shorts? Do you see how you would have easily have been able to make money? Sure, right? Absolutely no problems. And what happens next? We get a new lower price. The market rallies. So what do we draw on our lines? We now draw a bottom edge. So if we're now drawing a bottom edge because the market's now rallying, where is our top edge? Well, guess what? It's the highest high between the last two. So there's our new top edge. In other words, anything below that blue line is a what? Simon, Theo, Anything below that blue line is a what? It's a sell, right? It's a short trade. Anything below this blue line here is a short trade. So what are we looking for? Volume narratives or springs. So a volume or a spring narrative. So there's the spring possible narrative right there, yes? Would you all agree that this is a perfect spring narrative here? So there's a possible spring narrative right there. And what happens? The price breaks. And look at that trade, guys. It's only $1,500 at the end of the day per contract, but I think it's pretty good. I think it's a pretty good sell. I think we're on the right side of the trend. I think we're doing good business. And I've not had to do an awful lot of work to make my monies. So obviously when the market breaks below this area here, you can see obviously that now we're in a sell trend. I haven't seen any buy side pullbacks. So this sell trend is still valid until when? This sell trend is still technically valid until we break the high of this price here, yes? Still technically valid until we break that price at 111.50s. So in other words, the only trade we can do just now is to be short the marketplace. Now obviously when we introduce Wyckoff to this as a storyline, we can start to understand the concept. If we add Wyckoff to this, we can start to understand the concept of volume analysis, because this is obviously going to be hopefully a drop in volumes on these two candles, and then an increase in volume here. Now there's a problem why this might not be a drop in volumes, and that is because of the time of the day. It's coming into the NYMEX Open, of course. But obviously that's another pointer. It is coming into the NYMEX Open. The big volume's about to hit. So we should be ready for the big volume surge. But let's deal with this prior to the NYMEX volumes. If we look at this from a Wyckoff perspective, simply analysing the volume narratives, the one things that we're always aware of in Wyckoff is that he always starts basically with a big volume narrative, the biggest volume, possibly. Because big volume represents reversal trades. Biggest volume gives us ideas of a climactic volume price action and the like. So the biggest volume in this structure was obviously this huge break up to the top edge. And then we saw this drop off in volume from this point onwards. Look, all the volumes are dropping at this stage, yes? So when we even saw this top edge spring trade at the top line, you can see obviously the volume was increasing to get to that point, obviously. So when we saw the volume drop and then the volume increase there, that's the kind of buy I like to take, as you well know. So the volume was dropping on the down phase, and now obviously the volume rises on the up phase. Do you see that? 3 volumes rising on the green phase, 1, 2, and 3 volumes rising. So the one thing I'm not going to be doing is trying to sell top edges. I'm a buyer of bottom edges. Do you understand? Now, when the structure breaks here, now I'm in a sell trend. Remember, that's the structure break there that I was waiting for to go short. So what's the challenge? Well, we know where the big volume is going to come in. It's going to be in a spring trade narrative up here. There's the spring trade there. So we find the nearest and dearest, and we know it's 111.70s. So we start thinking about the possibility of spring trading that. A big volume up candle, a bigger volume up candle, but look at the size of the candle. It's getting smaller. The volume is getting absorbed. Good evidence. Probably getting a nice lean. If you were to look down into your order flow chart, you'd see the lean appears at the spring trade level. So you're not having to fade this on the way up. You're fading this basically, sounds as if it's a contradiction, but you're fading this on the way back down again after the lean comes in. Once somebody else is faded, you're joining the fade if you can, and you're obviously aggressively marking down price. As the price marks down, the volume increases and then decreases. Now in this candle, when it decreases, of course, this candle increases, a perfect example of a drive to the downside. When this candle decreases, and this candle decreases, you're a little bit worried. There should have been more volume on those cells. Having said that, the next volume obviously comes in and it's got a big volume candle, but it's got a very large pin attached to it. That's obviously confirmation that there are buyers in here. We thought there was probably buyers because of the drop-off in sellers here. So when the volume comes back in here, you're starting to think to yourself, okay, this could be a temporary low because of the drop in volumes. Now, this is what we call exhaustion. This is when you can start trying to think about the possibility of fading a low price based on Wyckoff, but not based on structure, because based on structure, the only trade is to sell, right? There is no buy based on structure. But based on Wyckoff, there's a possible buy, but you've got to make sure you see it. A drop-off in sell volume, preferably an increase in buy volume, which doesn't actually happen. But then the volume drop off, this is the test of that big volume in the background. This is what Wyckoff would term a test. Has everybody came across that Wyckoff expression before? This is when they test to see if there's any more supply coming into this area. So this is a low volume test. Look at the size of the volume in those two down candles. You need two down candles to prove that the volume is really low. It'd be better if the second volume candle was lower than the first, but it's, in terms of volume, it's slightly higher, but it's still incredibly low. It wouldn't have been difficult to be higher than the previous candle. So this is a low volume test. Now, obviously, if you added value to this low volume test, even though the structure was bearish, the low volume test with value would now be a valid opportunity to buy in at this stage only. How do you buy into that? Well, because the volume is declining, you can actually know that there's no selling. So you know that if there's no selling, that the price breaking back above here into the BSG squeeze and the tipping point is going to be a very good easy money buy trade. Now, in terms of structure, you know very, very simply that this should simply be a sell trade. A massive volume up candle follows on from that trade, but it has no follow through. So that's a sell candle. That's a sign of weakness. That's what Wyckoff would have called the sign of weakness. A sign of weakness is a big volume up candle with no follow through at all. So for example, we had a big volume up candle in the background here, big volume up candle, and the next two candles were buying. This is a big volume up candle, and the next candle went up as well. This is a sign of strength. Does everybody agree with that? That's a sign of strength. Or as Wyckoff would label it, an SOS, sign of strength. Whereas this big volume up candle here does not have any follow through. This is a sign of weakness. Does everybody agree with those definitions? Now, I'm not saying that every definition I come up with is going to be identical to Wyckoff. But it is just a standard storyline of the marketplace that's been around since history began. So what is this big green candle here? A sign of weakness. Now, you only know it's a sign of weakness after the event, right? You don't know it's a sign of weakness until the price doesn't go any higher. So there's a sign of weakness here. Now, what do you want to do when you see a sign of weakness? What do you not want to do on the green candle? Well, you don't want to sell the green candle because it's a big volume, right? You don't want to be a buyer here. You do not want to buy into that green candle. You don't want to buy into the green candle, but you don't want to sell into the green candle either. Yes, you don't want to sell into the green candle either because there's a lot of buyers, Theo, right? So we don't want to be a seller there, but it is a sign of weakness. So what do we want to see happen? Well, we talked about it at the previous bottom edge. We want to see that volume tested, yes? We want to see that volume tested here. So we want to go into that trade narrative there and get the test. And we want to see this idea up here getting tested by what? Well, preferably declining volumes. Because we want to know whether the demand is going to come back in at the high prices. So we want to see declining volumes against that narrative. Yes, yes, yes. Do we see declining volumes? Now, we know that if we get a spike above it, we're going to get a spring. The volume will probably increase. That we do know. And if it closes at the highs, you cannot sell it. But it doesn't close at the highs, does it? It's big volume. It pins in an area that we already know about as a possible sign of weakness level. We already know that there's a possible sign of weakness at this price. It's been tested on basically low volumes. But what else is visible there, Theo? You seem to be on the ball on this one. Anybody see it? What else is visible there? I'll give you a clue. Look at the red candles previous. The amount of volume on the sell is getting bigger. So during this phase, the volume was actually increasing on the offer. Yes? The volume was increasing on the offer. So that's obviously starting to point to the fact that there is a reasonable chance that there's a lot of selling pressure coming in this phase. Now we need to test to see the maturity of this sell side auction. We want to test this, and obviously it either tests on very low volume, going up to the top edge, which then fails to spring, or on a break above the top edge. Now, Wyckoff doesn't use I don't think Wyckoff uses the word spring in these areas. Wyckoff usually uses spring, for example, at the top edge or a bottom edge. I prefer to use the spring idea inside of the value after a top edge is in, but it doesn't make any difference. It's just a terminology, guys. You use whatever you like. But the point is here that that's going to be now a sell trade, so long as it doesn't close at the highs. We've got a sign of weakness. We've seen a drop in volume into the test. And now we've obviously seen the supply at lower prices. We want to be short here. What happens? That's what happens. We get that structural drop. Remember, we want to be short from the structural point of view. Yes? So from a structural point of view, we want to be short. From a volume point of view, we don't like the short. So at this stage here, the structure is a short trade, but the volume is suggesting that we should be trading long at the lows because the volume drops off on the short, yes? Right through that period till we get this reversal here. So obviously what we're trying to do is get what? What are we trying to do? We're trying to get the short structure to line up with the volume structure, yes or no? Well, come on. That's got to be a big desire of all traders. The volume and the structure agreeing with each other. And then obviously when you get into professional trading, the volume and the structure and the value all agreeing with each other for the perfect trade, right? That's what benchmarking is. But unless we get through these first two phases, we can't get through the final phase of getting it into a professional quality narrative, right? Unless we understand this structure and unless we understand this volume, we can't take care of the first two parts to the jigsaw puzzle. So I want to be structure short, and now the volume is short as well. So at this phase here, the structure is short, the volume is short. Now we want to be heavy short. Now we want to get into that heavy short. And the spring trade was glorious. And obviously the takeaway from that spring trade was your trade of the day, your benchmark trade of the day. Would you agree with that? A sell from 1150s, low price of 10 evens, 150 ticks of profit for a $1,500 profit, guys. $1,500. And obviously in terms of market structure, you can see that the short trade originally had a target price, and obviously we blew that target price into that huge volume there at 110.20s. We drifted to the 110 evens. Game, set, and match, guys. There it is. Your big trade of the day. Your benchmark trade of the day on oil. And that's it, guys. That's it. Because this is still what? Structure short, right? This is still a short structure, yeah? There is no buy trades. There is no opportunity to go long. There is no structural long trade narratives here. It's only a structural short. So when we understand these elements, we can see why and how we can get the perfect benchmark storyline. We can understand these elements beautifully. That is your benchmark trade. Any disagreements that that's your benchmark trade? Anybody not agreeing that that is the big trade of the day for any oil traders? I think we could all agree that that is a benchmark trade. Now, it's not just that that is visible, it's also a wholesale price. We can add that to the storyline. And if you look at order blocks indicators, if you've got order block indicators on your charts and you look at oil, if you've got order block indicators on your charts and you look at oil, for example, you can see that there's been an order block here from that toxic order flow back on the 17th of May at a price of 111.50s. 111.50s, we've seen one sell away from it, two sells away from it, three sells away from it, all from 111.50s. And based on that 111.50s, that's exactly where we just sold away from over there on that structural order block sell. Do you see why we benchmark this as a narrative? Absolutely. Absolutely. Now, obviously, what we would like to see in that area, of course, is the various other elements. We'd like to see a bubble forming. We'd like to see those starting points for bubbles. And do we see any starting points for bubbles into these areas here? 13.55. Well, let's take a look and see if we see any starting points for bubbles at 11.55. We did the bubbles conversation last week. And there's the bubble forming. Do you see how the blue and the purple line are going up and the red line is going down? This is a banker sell. It's not just a sell, it's a banker sell. Yes or no? Does everybody see the bubble forming? But now it's not just about that bubble forming. Now it's not just about this bubble forming in here. The bubble's great, but now it's just a bubble plus a structure plus a volume, plus well, levels are obviously structure, but you get the basic idea, plus a time of day, plus it's coming into the NYMEX Open. So when we add all of those elements together, it's not the structure that makes it a benchmark, and it's not Wyckoff volume that makes it a benchmark, and it's not the spring trade that makes it a benchmark, and it's not the time of the day that makes it a benchmark, but it's all of these pieces put together into one single trade. But it's not just those pieces put together into one single trade either, is it? Nope. What else? What about the volume? What about the withdrawal of liquidity order flow? What do you think about the withdrawal of liquidity order flow at that stage, guys? Let's take a look and see if it shows up. Okay, so here's the order flow. Does anybody see any order flow structure that could have got me into a short trade? And everybody gulps and goes, oh my goodness, this is possibly the best trade I have ever seen in my life. Because there it is. There is a massive withdrawal of liquidity on the bid, hence the reason why there's a drop in the red here, hard drop in the red, which doesn't get replaced when the market rallies behind that move. We get the move going through to the top edges here. There's the 111.50s. There's the Voltics, Delta extremes, Voltics, Deltas extremes, and a little block trade to lean against for that point there. And there's your sell trade opportunity. 111.52s, 111.50s, 111.49s, all are acceptable for the perfect sell. And as I said, the outcome, guys, $1,500 per contract from 150. So in other words, in a little over half an hour, You've just made $1,500 a contract on the one benchmarkable trade opportunity that is screaming on this oil chart. Is that not spectacular, guys? Is that not at the core of every great trade? Should you not be doing this on every market narrative? Is this not the basis of a perfect trade story? Into that big lean at the top edge there, and then the sell off of that trade right there is spectacular. If it's any use, I will do another article tonight. We said we'd do a few more articles where we actually do the full benchmark on the article based on this single oil trade. And we'll pop it into the Smart Alpha trade structure folder again as to all the elements of this as a benchmark trade opportunity. All the elements of this as a benchmark trade opportunity. Yes? Perfection, guys. Absolute perfection.